All right, so let's talk about one of the most popular, fast-growing loan programs in the country today for investors. It's a debt service coverage ratio loan. So we call it DSCR. Let's jump right into it. So first of all, what is a DSCR loan? It's a loan for investors purchasing residential real estate. And the cool thing about it is that it allows you to qualify based on the income of the property, not your personal income. That's the basic concept. I've got a lot of other videos you can check out, but let's go into the pros first. So here are the pros of a debt service coverage ratio loan. Personal income doesn't matter. You don't have to have a job to qualify for this type of loan, which is a huge benefit for many investors. That's definitely the number one advantage of a DSCR loan. No income documentation. Since you don't need a job to qualify, we don't need W-2s, we don't ask for pay stubs, tax returns, or any other income documentation. That's another major benefit. And there's no property limit. There is generally no limit to the number of properties you can own with a DSCR financing. You could have 10, 20, 50, and up to 100 properties. Some lenders, though, may limit the number of DSCR loans you can have with their company, but in general, there is no finance property limit like there is with conventional loans. With conventional investment property financing, you're generally capped at 10 finance properties. Some companies even have 4, but DSCR loans don't have that restriction. So there are multiple property types that are eligible also. The DSCR loan can be used for single-family homes, condos, townhomes, PUDs, and 2 to 4 unit properties. And in some cases, even 5 to 10 unit properties can qualify under residential DSCR programs. So the long-term financing available is really attractive. You can get 30-year fixed terms, sometimes 40-year fixed terms, and interest-only options with these loan programs. The interest-only payments can help lower your monthly payment and improve your cash flow. The short-term or long-term rentals, unlike many conventional loan programs, DSCR loans can often be used for long-term rentals and short-term rentals like Airbnbs and VRBOs. This flexibility is a major advantage for investors. So the minimum reserve requirements are that many DSCR loans require fewer reserves than conventional loans. With strong credit, you may only need 3 months of reserves. For cash-out refinances, some programs allow the cash-out proceeds to satisfy reserve requirements, but this can vary from investor to investor. DSCR loans are business purpose loans, which means you can often close in the name of an LLC or a corporation or your personal name, which you cannot do with conventional investment property loans. Conventional loans typically require the title to be held in your personal name, but this is not the requirement for DSCR. There's also typically a lot less documentation. Since we're not documenting personal income, there's generally much less paperwork required. There's no need to go gather your tax returns, your W-2s, your pay stubs, and all the employment documentation. This often results in a faster and simpler process. So those are a lot of the pros. Let's talk about some of the cons or the downsides of a debt service covered ratio loan. So first of all, there's prepayment penalties. This is one of the biggest drawbacks. Most DSCR loans include prepayment penalties depending on the state and the loan program. And prepayment penalties may range from 1 year, 3 years, and 5 years. Generally, the longer the prepayment penalties, the lower the interest rate. So if you can go longer before you make have a prepayment penalty, then the better interest rate you get. Shorter or no prepayment penalties equals higher interest rates. So each situation is different. So it's important to evaluate your options carefully. Higher interest rates. The debt service coverage loan rates are usually higher than conventional financing, but we are seeing now in the last few months that is not always the case. In fact, oftentimes rates are lower than conventional rates. Typically, rates can be 0.5% higher, sometimes 1.5% higher, but again, the investor appetite has changed and we're seeing those actually lower, sometimes better than the typical conventional financing. So the exact difference depends on the borrower's credit profile and the type of property. Sometimes these DSCR loans often come with loan origination fees that may be higher than conventional financing. The flexibility these loans offer typically comes with slightly higher costs. It usually requires 20% down. Most DSCR loans require at least 20. Some programs will allow as little as 15% down, but rates are significantly higher and cash flow becomes harder to achieve. But since debt service coverage ratio loans don't have mortgage insurance, lenders often compensate by increasing the interest rate. So cash flow is critical. Here's how it works. If the rental income does not adequately cover the mortgage payment, which would include the principal, the interest, the property taxes, and homeowner's insurance, the property may not qualify. Sometimes projected rents look really strong, but the appraised rent schedule comes back lower than expected, which can then affect approval. There are low ratio and there are no ratio options available, but pricing is typically very less favorable. So many DSCR programs allow credit scores as low as 640. However, rates are very much unattractive at that lower credit score. Loan-to-value limits may be reduced. Generally, borrowers with scores above 680 to 700 receive much better terms. And most lenders prefer a DSCR ratio of 1.0, 1, or higher. Although we do have programs that do exist that go lower than 1.0, but they usually come with higher rates, sometimes additional fees, and somewhat less favorable terms. But the final thoughts on a DSCR loan. Overall, these loans are one of my favorite financing options for real estate investors. They offer tremendous flexibility, especially for investors who want to scale quickly, have complex income situations, they already own multiple properties, and they prefer qualifying based on property income rather than their personal income. So if you're considering purchasing or refinancing an investment property, a debt service coverage ratio loan may be very much worth exploring. Whether it's a purchase, a rate and term refinance, or a cash out refinance, it's a powerful tool for building a real estate portfolio and has quickly overtaken the popularity of a traditional conventional investment property loan program. So if you want to know more, if you're interested in looking at this, give us a call. We can put it together, run some numbers for you, and show you how to use the DSCR to build your investment portfolio.